Hi everyone, I'm Julie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics this week: topic number one, from good returns on the 22nd of July, predictions for OCR cut next month. Topic number two, the mortgage mag, 23rd of July, Deloitte, shared equity schemes could arrest declining home ownership. Topic number three, from Stuff on the 25th of July, teenagers buy their own home after years of saving at their supermarket jobs. Topic number four, from RNZ on the 24th of July, rents falling for the first time in nearly 2 years, data shows. And topic number five, from RNZ on the 23rd of July, more home rate cuts if you can get them. So first up this week, from good returns on the 22nd of July, predictions for OCR cut next month. Key data, particularly the labour data due on August the 7th, and various inflation expectation measures could lead to an interest rate cut if they're weak enough. ASB Chief Economist Nick Tuffley suggests that every Reserve Bank of New Zealand RBNZ meeting from now on could result in rate cuts, potentially totalling 75 basis points by the end of the year. Even without a cut next month, the bank anticipates 25 basis point cuts in both October and November as core inflation decreases for both imported and domestic measures. Tuffley believes that a 25 basis point cut in November is the minimum that the Reserve Bank needs to implement for the remainder of the year. He highlights that data revisions are trending downward, with various core inflation measures, including the RBNZ's sectoral factor model, showing significant declines. This trend supports the view that inflation pressures are diminishing quickly enough for the Reserve Bank of New Zealand to act without waiting for third quarter CPI data. Before the RBNZ's October meeting, Tuffley notes the central bank will consider several economic indicators, including selected price indices, second quarter GDP, which is expected to be weak, the NZIER quarterly survey of business opinion, and early assessments of consumer spending influenced by impending tax cuts. Collectively, these data points may shift the RBNZ's focus from the risk of easing too quickly and potentially in causing inflation to exceed the 3% to the risk of maintaining overly tight monetary conditions and the associated economic costs. According to ASB, the reduction in inflation has been driven primarily by falling imported prices as pandemic-related price increases unwind. Domestic inflation has been slower to cool, partly due to cost-driven influences that monetary policy should overlook. Excluding these cost increases indicates that annual underlying CPI inflation is already well below 3% and is likely to continue decreasing. Tuck doesn't expect higher costs to trigger renewed wage and pricing pressures in the current environment. He asserts increases confidence that core inflation will stabilise between the 1 to 3% target range, even with modest OCR cuts. My thoughts on this are that although I do agree that the Reserve Bank should make a 25 basis point cut next month, I suspect they'll wait for a little bit longer because they do tend to err on the side of caution. At the moment, we do have banks reducing their interest rates because of declining swap rates. So, they're kind of doing a bit of the Reserve Bank's job for them. But we shall see. Second topic for this week, from the Mortgage Mag on the 23rd of July, Deloitte, shared equity schemes could arrest declining home ownership. Shared home equity schemes, including leasehold, rent-to-own options, and third-party contribution towards deposits, could help mitigate the decline in home ownership in New Zealand, according to a Deloitte report commissioned by Westpac. The report indicates that shared home ownership solution could provide necessary support for New Zealanders struggling to enter the housing market and assesses the scalability of these solutions. Existing shared equity schemes, though currently small, have seen rapid growth since the Ministry of Housing and Development's Progressive Home Ownership Fund was introduced in July 2020. More than 1,700 shared home ownership homes have been delivered since then, compared to roughly 1,000 between 2007 and July 2020. Deloitte notes that constraints to these schemes include funding availability, credit conditions, debt costs, land and construction expenses, and the lack of a national affordable housing strategy. Additional barriers include the financial capacity of prospective homeowners, limited awareness of these options, and uncertainty about central government policy. These challenges are not unique to New Zealand. Other markets, such as Australia and the United Kingdom, also face housing unaffordability and a need for shared homeownership solutions. While these countries have not yet perfected shared home ownership, they are making progress. New Zealand can learn from their practices to develop effective, sustainable, and fair programs. Deloitte's analysis of a customised Statistics New Zealand data set identified 50,000 households that could be eligible and aware of shared home ownership pathways. If awareness was not a limiting factor, the report also highlights a decline in home ownership from nearly 75% in 1991 to about 60% now, with projections suggesting it could drop below 50% by 2048. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor, and these events are available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, but we do have over 25 years of experience as property investors. It's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website, and that's propertyapprentice.co.nz. Third topic for this week in review from staff on the 25th of July, teenagers buy their own home after years of saving at their supermarket jobs. At 16, Charlie Simmons set a goal to own a home by 20. His girlfriend, Courtney Morrison, had lived in rentals and never even considered home ownership. Now at 19, they're about to purchase their first home in Taupo for $720,000. They saved the $160,000 deposit from their supermarket jobs at Pack and Save. Simmons is a grocery supervisor and Morrison works in the deli. Simmons, who began working with a paper run at age 12, has saved consistently during his 5 years at the supermarket, inspired by his family's financial advice. Simmons credits his dad, who he regards as his financial advisor, and his older brothers, who bought their house together when they were young, for sparking his interest in property. While his friends spent on luxuries, he focused on saving. Despite working up to 20 hours a week in high school, Simmons maintained strong grades, finishing year 13 with high honours. Although university was an option, Simmons preferred the supermarket industry, aspiring to own his own store. He is completing NZQA courses through Foodstuffs. He chose to work full-time and save money while his friends pursued degrees. And though some people find it odd that he works at a supermarket, he said he values the diverse experience he's gained there. Simmons and Morrison, who started dating in year 13, have saved together since she decided to forego university. Simmons doesn't feel he's missed much to achieve their savings goal, aside from a few luxuries and nights out. Morrison thinks their shared goal made the process easier, as she previously thought home ownership was out of reach due to her rental background. Their new house, which they'll own from August 28th this year, is a 109-metre square, 3-bedroom, 2-bathroom home built in the late 90s, located near his parents' house with a view of Lake Taupo. Simmons finds the transition to home ownership significant but exciting, seeing it as a new chapter with plans for flatmates to help with the mortgage. Financially confident, he believes they got a bargain, noting the house was valued at $850,000. Looking ahead, they aim to buy a 4-square store as a step towards owning a New World supermarket. Simmons' father, Jared, is proud of their focus and hopes their story inspires others. Credit Bureau Centrix reports the average age for first home buyers in New Zealand is 37. So congratulations. I think that is absolutely an inspiring story for all young New Zealanders, and just proves the fact that if you've got a goal in mind and you make a concerted effort to reach that goal, you will get there. But you do have to believe that you can do it. So I think congratulations is well deserved for that young couple, and I hope that their future is as rosy as I would expect it to be. Topic number 4 from RNZ on 24th of July, rents falling for the first time in nearly 2 years, data shows. Rental prices have decreased for the first time since 2022, according to TradeMe data. The latest rental price index from TradeMe showed a minor reduction in rents, with the national median dropping $5 down to a still eye-watering $645 per week. Evan Lloyd, TradeMe's property sales director, noted that this was the first monthly decline since September 2022. He also indicated that rents might continue to decrease. Lloyd explained that with more Kiwis leaving the country, there is reduced demand for rentals, especially between young professionals. Consequently, rental prices could fall further as we progress into the winter months, especially with inflation figures dropping faster than anticipated. However, rent in Northland, Auckland and Wellington remain stable, with Auckland retaining its status as the most expensive region, with a median rent of $690 per week. Topic number 5 from RNZ on the 23rd of July, more home loan rate cuts if you can get them. ASB has joined the wave of rate cuts by lowering all of its fixed home loan rates, though it cautioned that these changes might take time to benefit households. ASB now offers all of its fixed mortgage rates below 7%, which is a first among major banks since June of the previous year. Specifically, the 6-month fixed rate has decreased by 25 basis points to 6.99%, and the 1-year fixed rate dropped by 29 basis points to 6.85%. The 18-month rate is now 6.69%, down 20 basis points, and the 2-year rate has fallen to 6.49%, which is a reduction of 26 basis points. Additionally, the 5-year rate has decreased by 4 basis points to 5.99%, with minor reductions in the 3 and 4-year terms. For a $500,000 mortgage over 30 years, the reduced 1-year rate translates to a weekly saving of approximately $20. Adam Boyd, ASB's Executive General Manager of Personal Banking, attributed the rate cuts to declining wholesale rates, or swap rates, as they're commonly called. Well, he acknowledged the ongoing financial difficulties for many New Zealanders and expressed satisfaction in offering some relief through lower home loan rates. This move follows similar actions by Westpac, which responded first to the Reserve Bank's recent official cash rate update, as well as subsequent rate cuts by ANZ, BNZ and Kiwibank. Many others have followed since then as well. Despite the rate reductions potentially lifting borrower spirits, actual relief may take them time to materialise. Reserve Bank data indicates that of the $263.29 billion in owner-occupied home loans, $50.3 billion will be refixed in the next 3 to 6 months, $70 billion in 6 months to a year, and $52 billion in 1 to 2 years. Kiwibank Chief Economist Jared Kerr noted that while the trend towards shorter fixed terms means that the impact of rate cuts may be quicker than in the past, it still won't be immediate. He explained that historically it takes about 18 months for rate cuts to fully affect borrowers, though the shift towards shorter terms has expedited this process somewhat. Kerr also pointed out that even if borrowers cannot immediately benefit from lower rates, the knowledge that rates are falling have a positive psychological effect. My advice would be talk to your mortgage advisor, because you might be able to break your fixed rate and fix a lower rate without paying any penalty interest if you do it sooner rather than later, but it will depend on your situation. So reach out and speak to your mortgage advisor if you've got concerns. Unlock the door to your property investment success at our free events called How to Succeed with Property Investing. Whether you're a first home buyer or an aspiring investor, this is your chance to gain invaluable insights and strategies that can transform the property journey. As an experienced property investor and also a financial advisor, I'll share valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. I'll also tell you more about how we help our clients to achieve financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for our events. Alternatively, you can book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. Thanks for listening.